Hello, my name is Karen Dunn, and I am one of the small business retirement plan experts here at Independent Actuaries. Independent Actuaries is the largest independently owned actuarial consulting firm in the Pacific Northwest. We work on most types of retirement plans for all types of businesses, but we specialize in the design, implementation, and administration of defined benefit plans for small businesses. A defined benefit plan, or DB plan, is a unique but often underutilized solution for a number of challenges affecting closely held business owners. So today I'll begin by talking about the differences between defined contribution and defined benefit plans, the advantages and disadvantages of each type, and the specific situations or challenges where a DB plan could be a solution, including examples and case studies. Now, most of you are probably familiar with defined contribution type plans. Examples of this type include 401k plans, profit-sharing plans, SEPs, simples. Here, the contribution is defined, usually as a percent of compensation, and can be made by the employer or by the employee. The contributions accumulate with investment earnings until such time as the participant is ready to take a distribution. The amount of savings a participant has at retirement is uncertain since the rate of return is unknown and both employee and employer contribution amounts can vary year to year. Defined benefit plans work a little differently. Examples of this type of plan include cash balance plans, floor offset plans. They are sometimes referred to as traditional retirement plans or pension plans. Here the benefit is defined, usually as a percent of compensation for each year of service, and payable as an annuity at a specified retirement age. Each year, a contribution is determined by the actuary and made towards that retirement benefit. So the contribution is unknown and can vary from person to person. Now, there are several relevant differences between the two types of plans that I want to briefly mention here, and will then expand on them as I go through the presentation. One difference is that in a DC plan, the investment risk is borne by the employee. In a DB plan, the investment risk is borne by the employer. This means that in a DB plan, an employer can make up investment losses with additional contributions and keep on track with their retirement goals. Another major difference is that contributions to a DC plan can be discretionary, whereas DB plans will generally have a required minimum contribution. That defined benefit at retirement must be paid for over the working lifetime of the participant, which creates a certain level of funding obligation. The older the participant, the higher the contribution, since the period for funding that retirement benefit is shorter. Another difference pertains to the certain maximums that the IRS imposes on retirement plans. In a DC plan, the maximum applies to the contribution, and in a DB plan, the maximum applies to the benefit. I'll go into more detail on this later. And the last difference I want to mention is that in a DC plan, a business owner needs high current annual compensation to maximize contributions. In a DB plan, the benefits are based on compensation over the highest 3 consecutive year average, so a high current year compensation is not needed. Okay, now I want to go through a bit about the advantages and disadvantages of each type of plan. Now, for a DC plan, the principal advantages are they're appreciated by employees, easy to understand, extremely flexible, and contributions are generally discretionary. The principal disadvantages, the low contribution limits, they're not designed to be a plan primarily for owners, and it's difficult to build sufficient retirement plan savings in a short period of time, and you need high current compensation to maximize the contribution. For a defined benefit plan, principal advantages are substantially higher contribution limits, greater assurance of achieving retirement goals, generally a higher benefit for owners relative to rank and file employees. A wide range of allowable contributions provides some level of flexibility, and again, current salary is not necessary to make a contribution. Principal disadvantages are they're more complicated and so therefore less understood, may be underappreciated by the employees, and a minimum employer contributions may be required. Now, in order to maximize the advantages of a DB plan, they work best if the business owner is over age 40, has historical compensation in the 6-figure range, has no employees, or employees are younger and lower paid than the owner. So now, I want to talk through some of the challenges where a DB plan could be a solution. The first one I want to talk about is the business owner is looking for a larger tax deduction and retirement benefits than a 401k plan can provide. Let's look at a simple chart of how contribution levels compare between the different types of plans at 3 different ages for an owner-only plan. So you can see in this chart, we're gonna the blue bar is for a business owner who has only a 401k profit sharing plan. Here, if the business owner is age 40, he or she can contribute $57,000 a year to that profit sharing 401k plan. At ages 50 and 60, that amount increases to $63,500 per year. Now, if this owner had a DB plan only, the average contribution a 40-year-old could do over the next 10 years would be nearly $120,000 per year. At age 50, that average increases to $163,000 over the next 10 years. At age 60, over the next 5 years, this owner could contribute $235,000 per year on average. Now, this owner could also have both plans, both a DB and a 401k plan, and get a little bit extra annual contributions for each year. At age 40, the amount increases to $155,000, age 50, $206,000, and at age 60, $278,000. So you can see the annual deductions are far greater with a DB plan or with a DB plan and a 401k plan together. The next couple of challenges I want to talk about are the business owner who wants to accumulate a lot of money toward retirement in a short period of time, and the business owner who wants to achieve a specific level of retirement income. Now, it's not uncommon for small business owners to forego retirement savings in the early years of growing a business and would like to make up for lost time. A DB plan allows the owner to do this. Now, I want to take a second and talk a little bit about the retirement plan maximums. Now, in a DC plan, remember, the annual contribution is limited, but in a defined benefit plan, the benefit at retirement is limited. So let's look at how this might work. This owner wants to set up a retirement plan at age 52 and retire at age 62. Let's assume annual investment returns of 6% for both types of plans. And let's start with a profit-sharing 401k plan. Here, the maximum annual contribution this owner can make is $63,500 per year. At 5%, this will accumulate at retirement to approximately $835,000. This will vary based on investment return, and losses cannot be made up. On the other hand, a defined benefit plan, the maximum benefit at age 62 has a value of almost $3 million. That translates to an average annual contribution of $217,000 per year. And this will also vary based on an investment return, but the owner can make up for the losses with some additional contributions. The next challenge we're going to talk about is the business owner who wants larger deductions but still needs flexibility in the contribution amounts. Let's talk a little bit about how funding works in a DB plan. DB plans have a promised benefit at retirement that must be paid for. This means there's a certain level of required contributions. The rules allow for a minimum required contribution and a maximum deductible contribution, with the average generally somewhere in the middle. What this means is that the employer can front load or backload the contributions to some degree. We can also freeze or reduce benefits if we need to help manage contributions. So let's just look at a quick real-life example of how this might work. Here, the owner wanted to set up a plan at age 64. He had average compensation of $175,000 per year, and we set up a plan to target a $250,000 per year contribution. Now you can see from the chart the allowable contribution ranges are quite wide in each year. This again is the minimum required and maximum deductible range. Now in the first couple of years, this owner fell short of that $250,000 targeted contribution, but the $170,000 he did put in was still well within the range. In the third year, however, he really needed to reduce the contribution, so we froze the accruals in that year to manage this contribution. But in the last couple of years, 2018 and 19, he was able to make up for lost time by putting in $350,000 contributions for those years and get back on track. Again, lots of tools in our belt for managing a contribution to keep things within an acceptable level for the business owner. Okay, so now I want to talk about the business owner who wants to provide retirement income for employees, but relatively more for themselves. There's different ways to accomplish this, and it will very much depend on the actual demographics of the business. But a common strategy that we use is to pair a defined benefit plan with a profit-sharing 401k plan, such that the owners receive most of their benefit in the DB plan, and the rank and file employees receive most of their benefits in the DC plan. Now again, there's lots of ways to accomplish this, but I just want to show one quick example. This is a DB-DC combo, where the DB plan is actually a cash balance plan, and the DC plan is a profit-sharing 401k plan. Now here, in order to meet all of the goals for this employer, we have the profit-sharing plan provides 8.5% of pay compensation to the rank and file employees, and a very small amount for the rank and file and the cash balance, but a significant contribution to the 4 owners. So the cash balance plan contribution, the total, 98% goes to the owners, and with an overall contribution of nearly 90% to the owners. All right, so our next challenge, the business owner looking to take full advantage of deductions under the Tax Cuts and Jobs Act. Now, under this act, there was a creation of a deduction for certain pass-through income, a Code Section 199A deduction, that provides for a deduction of up to 20% of qualified business income. Now, if the business owner's taxable income is too high to take advantage of the QBI deduction, a large pension contribution can drop it below the applicable threshold. The details of how this works are extremely complex and beyond the scope of this presentation, but I'll just show you a quick example of how this might work. So eligibility for the QBI deduction in 2020 is based on taxable income. Married filing jointly get a full deduction if 2020 income is under $326,000, but no deduction if the taxable income is over $426,000. So for example, say an S-Corp owner has $500,000 in taxable income, so is ineligible for the QBI deduction. If they add a DB plan allowing for a $250,000 annual contribution, gets the deduction for the contribution as well as the full QBI deduction. We call this a supercharged deduction. So the last challenge I want to talk about is for the business owner looking to facilitate selling their business while reducing the tax impact. Now, many small business owners think of their business as their retirement plan. Sell the business when they're ready to retire and live off the proceeds. Well, why not use an actual qualified retirement plan with all of its tax advantages to accomplish the same thing? Now, this can be utilized in either an asset or a stock sale. It works best if sale proceeds are made in installments, and the sale proceeds are all or partially deducted as pension plan contributions. The owner receives sale proceeds as tax-deferred income, and the tax advantages may allow for more flexibility in the sale price. So let's first look at a asset sale example. Joe is the only employee at age 54. He's 54 in 2015. Compensation's $200,000 a year. He's had a profit-sharing plan, has been making the maximum of contributions. In 2015, he sets up a DB plan, and in 2018, he sells the business. So here is what this looks like on a chart. The first 3 years, compensation of $200,000 limits his defined contribution, annual contributions to $50,000. Sets up a DB plan in 2015, drops his current income because maybe he's paid off the house, kids are out of college, doesn't need the current salary, so moves some of those that money into plan contributions, $250,000 per year for a few years. Then in 2018, sells the business for 3 annual installments of $250,000 each, which he puts directly into the defined benefit plan as deductible contributions. Now, this can also work with a stock sale, and this works best when the sale is to family members or other current employees. It's usually a longer-term strategy. The owner should still be working when the process is started. The DB is set up to primarily benefit the owner with minimal benefits to the other employee. And a benefit with a lump sum value equivalent to all or part of the sale price is provided at retirement age. Now, this allows the buyer to purchase the company with tax-deductible contributions and the owner to receive sale proceeds as tax-deferred income. Now, the details of this can be quite complicated, so I'm not going to go through them in this presentation. But again, you can always call one of our experts if you'd like to talk through how this might work. Hopefully this overview has given you an idea of how a defined benefit plan can be a valuable tool to help small businesses achieve retirement goals and manage tax liability. If you have any questions or want more information, please visit us at independentactuaries.com or contact us at the number or email shown on your screen.